Welcome back to HECMWorld Weekly. It's easy for us as American reverse mortgage professionals to forget that we're not the only nation that offers reverse mortgages. And while reverse mortgages have been in India for nearly 15 years, the program, not unlike the United States, has not gained widespread acceptance. They also face similar misconceptions that spans both oceans and cultures. In one study, Money Life Foundation noted the Indian program faces more misconceptions about the reverse mortgage loans than other financial products available in India. And those misconceptions center on the fear that the home would pass on to the lender or losing title, that regular payments are required like a conventional loan, and even more unsettling, that the lender is responsible for the upkeep, property taxes, and property insurance. Now, how do reverse mortgages work in India today? Well, here are some highlights. First is eligibility. The minimum age is 60 or 58 for a spouse in a joint application. The Indian resident must be in a self-occupied residential property for at least a year, and there must be no outstanding loans or dues on that property. Now, some lenders do have additional requirements, such as a minimum property value or location. Now, here are some of the loan features of the Indian reverse mortgage. The loan amount depends on the age of the borrowers, property value, and the prevailing interest rates, and they get typically up to 80% of the property value that can be accessed in the end. Now, reverse mortgage lenders in India and here face very similar challenges, but also market opportunities. And we'll keep an eye on the reverse mortgage product in the Indian subcontinent, and we'll bring you updates as they are available. Last week, U.S. Treasury yields jumped modestly following the Martin Luther King holiday. However, the 10-year constant maturity Treasury rate began to surge on Friday before the holiday weekend. It jumped 14 basis points in just 1 week. Since Christmas, 10-year Treasuries have increased over 30 basis points. So why the sudden reversal of fortunes? Some analysts point to recent comments from the Federal Reserve in their commentary, and that hints at any cutbacks in interest rates in the future are likely to come more slowly and perhaps later than anticipated. Federal Reserve Governor Christopher Waller said, "When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully," he added. In many previous cycles, they cut rates reactively and did so quickly, and often by large amounts. This cycle, however, I see no reason to move as quickly or to cut as rapidly as in the past. Waller's comments do come on the heels of the most recent December CPI report, which shows an unexpected, albeit modest inflation increase, pushing the annualized consumer price index to 3.4%, up from 3.1% in November. While inflation has substantially cooled since its peak and the Fed's historic rate hikes, economists do remain concerned that too much, too soon in interest rate cuts could see the cost of living surge again. CNN reports that Gary Richardson, a Federal Reserve historian, is worried that policymakers are now contemplating rate cuts after a pause, and they risk repeating the central bank's mistakes that they made in the 70s. That was certainly the case when the Fed chairman, Arthur Burns, increased interest rates dramatically between the years 1972 and 1974, and then as the economy began to cool, he reversed course and began to cut rates. Shortly after, inflation came roaring back. And in our final story, Housing Wire reported last week that Ginnie Mae intends to develop a new reverse mortgage-backed security product, and it would enable the acquisition of loans from a HECM mortgage-backed security pool above the existing 98% maximum claim amount requirement, that according to a recent announcement. Now, this new product would complement, not replace, the existing HECM mortgage-backed security or HMBS program, which is in place today. Ginnie Mae's tentative plans address the liquidity challenges reverse mortgage lenders have faced for over a year, which were triggered by RMF's bankruptcy, a collapse of loan volume, and also a historic increase of interest rates throughout 2022 and 2023. In light of continued liquidity constraints in the reverse mortgage sector, Ginnie Mae is exploring the viability of a new securitization product that would accept HECM loans with balances above 98% of FHA's maximum claim amount, said the announcement. This new product will not change the requirements for the existing HMBS program, where HECM loans with balances at or above 98% of the maximum claim amount are required to be bought out of the HMBS. When a HECM loan reaches 98% of the maximum claim amount, current rules do stipulate that the issuer or investor has to buy the loan out of that pool. And that is really ensuring a means of broader HMBS acceptance in the program. Now, by exploring the new product, this would allow loans with a higher balance to be part of a new securitization. And Ginnie Mae is aiming at adding more stability to the secondary reverse mortgage market. Thank you. This announcement affirms Ginnie Mae's commitment and also its understanding of the importance of the reverse mortgage and what it holds for older homeowners. Given the growing population of older Americans that may need to rely on home equity for financial support, continued efforts to provide stability in the secondary market are crucial to the ongoing health and access of the FHA HECM product, said Ginnie Mae President Alana McCargo. Now, this news was greeted warmly by our industry trade association. NORMLA President Steve Irwin said, Ginnie Mae launched a couple of significant changes to its pooling requirements for the HMBS program in 2023, and I commend Ginnie's continued attention to the HMBS program so as to further mitigate HMBS issuer liquidity risk. That is really the engine for our industry, folks. I know it's out of sight and out of mind for most of us, but we have to have that secondary market functioning properly, and we also have to take some of the strain off of reverse mortgage lenders and those who are putting these pools together. Sounds like this is a good step in the right direction. And that's a wrap for us this week. Thank you so much for joining us. If you find yourself one week unable to watch our podcast, no problem. We have an audio edition as well, which you can find on Apple Music, Spotify, Podbean, or at HECMWorld.com. Thanks so much for joining us. Please share this podcast, if you would, with others, and have a great week.